of Mira Securities USA, and the call's moderator. Before we meet our guests, I do want to thank our sponsors who make events like this possible. We are joined today by Greg Kastner of Baker Tilly to discuss the often complicated and confusing rules and regulations governing state sourcing of income generated by hedge funds and private equity vehicles. Greg is a senior tax manager in Baker Tilly's financial services asset management practice and has over 21 years of public accounting experience, with the last 15 being spent concentrated in this area of alternative investments. I want to welcome Greg Kastner.
Thank you, Bob. It's good to be here.
The topic you've chosen to speak to us about today, Greg, is a pretty timely and relevant one in our ever-changing tax environment.
That's right, Bob. So state sourcing rules and considerations, these seem to change on almost a monthly basis. I've actually summarized the topics I'd like to today in the slide I'm about to put on. It's going to work. Yeah, it seems to not work. But anyway,
oh, there you go.
There we go. Now it's working. Okay. So anyway, basically what the states are saying is that everyone wants to increase their piece of the pie, and what makes it really confusing to people that aren't, used to tax, non-tax professionals, and to be honest, even us in the profession, is that there truly isn't any consistent method being used across different jurisdictions. Like states such as New York don't even apply the same methodology to corporations versus partnerships. You can, and you aggregate the percentages that is paying tax on to the different states, you can actually end up paying more than 100% of tax on. So that's kind of crazy.
Well, not only is it crazy, it seems unfair. So, is there any remedy to this?
As you're probably aware, Bob, hedge funds and private equity vehicles are organized as limited partnerships or limited liability companies. So there are some exceptions when passing through the characteristics of the income when it's not desired. So if you've heard of blocker corporations, those are sometimes set up to not pass through those characteristics when you have foreign investors or and you have income that's sourced to the United States, and especially in the case when you're invested in real estate, in U.S. real estate. And I've written another article that kind of covered that on our Baker Tilly website, that if anyone's interested, they can please reach out at the end or, take a look at that. I encourage that. But, circling back to your question, Bob, when an entity is organized as a partnership or an LLC, taxed as a partnership, it generally does not pay income tax, but passes through that income that it receives to its partners or its LLC members. And they ultimately pay tax on that pass-through income, and that income generally retains the same character that it had in the hands of the partnership. So if the partnership received capital gains, long-term capital gains, or qualifying dividends, that partner tax at the long-term capital gain rate or the qualified dividend rate, which is slightly lower than the regular ordinary tax rate. And so by doing that, partnerships aren't subject to the dual level of taxation that corporations are.
But don't some states impose entity-level taxes and fees on partnerships?
Yeah, that's right, Bob. New York, for instance, imposes this 4% unincorporated business tax on net profits. So if you're organized as an LLC or a limited partnership, you end up paying this tax in the city. Washington, D.C. has a fairly new and quite onerous franchise tax, and California levies a gross receipts fee. If the partnership ends up having, the same income taxed in more than one jurisdiction at these entity-level taxes, you might not actually have much remedy, except that you might get, and you have to look at the specific rules for each state, but you might get a credit for those taxes paid, or you might get a federal deduction for the fees paid. But the ultimate owner ends up paying tax. Let's say they pay 100% of their tax in New York, and they end up paying 10% of tax also in Massachusetts. They generally, on their New York return, they might be able to get a credit for that double income, and but you generally have to look at the individual, the individual's own tax situation to see how that works.
So it sounds like there's a degree of complexity involved in all this. So how would that work, roughly speaking, Greg?
So if you lived in Arizona, and Arizona has roughly about a 4% tax rate, and you got some income that's sourced to California, and California has a 9% tax, so you could credit for the tax that you paid in California, but you could only get a credit up to the Arizona tax rate. So you'd only essentially get a credit for the 4% instead of the full 9% that you would pay in California. So even though you live in Arizona and you're saying, hey, I should be only paying a 4% income tax rate, because of this income that's being taxed by two states, you might end up paying, a little bit higher when you average it out, maybe 5 or 6%.
Okay. How do the states actually apportion income?
There were two key concepts that govern state income taxes, Bob. The first is nexus, which is the legal or economic connection that permits a state to require a business like an investment advisor to file an income tax return. Once nexus is established, the second concept, sourcing, comes into play. Sourcing rules determine the methods used by a business to assign income to the states in which it has taxable activities.
So what's nexus?
Business has nexus in the state. Depends on the amount and type of business activity present there. For instance, physical presence in the state can be established through having employees, partners, or other agents there. And, these days you've got to keep in mind telecommuters, either in the management of the hedge or private equity, or the traders that are working for the fund. You can also own lease property in the state, or you can invest in or actively manage a partnership that receives income that's sourced to that state. So any of those would create nexus.
Ever be subject to tax in a state that you have no nexus in? That California is especially aggressive in collecting its $800 minimum franchise tax.
Yeah, you wouldn't necessarily always be subject to it, but this might come after you if, let's say, you registered to do business in that state and then never actually open up business in that state, or you leave the state and they require you to say, oh, I've left the state, and file dissolution papers. Like California is one of those states that does enforce that.
I've heard that some states are moving away from the traditional three-factor formula to apportion income. So what's changed here, Greg?
That's right, Bob. Traditionally, state income was apportioned among states using a variation of a three-factor formula: sales, payroll, and property. And that's probably what most people are kind of familiar with. And some states equally weighted each factor. Others more heavily weighted states. The factor usually was multiplied by 8. Rent expense was usually multiplied by 8 to be included in the property factor, so people could get out of having nexus in a state by just renting all their property. However, in recent years, many jurisdictions have transitioned to a single factor formula, which is sales. But
there are nuances to how sales are apportioned. I mean, especially in light of the expansion of e-commerce and telecommuting, as you mentioned before. So it doesn't sound like it's so cut and dry.
Sales used to be apportioned using what is now called the cost of performance method. Revenue was sourced to where the work was done to earn that revenue. So if a hedge or private equity fund's office were in New York, the management fee income, based on a percentage of the assets under management, was sourced to New York, regardless of where the investors resided, and probably only New York return was filed for that management company.
That changed, didn't it?
Yeah, that's right. The cost of performance runs into either a proportionate or all or nothing. With proportionate, if work was performed, let's say 40% in one state and 60% in another, sales were apportioned in the same way. With an all or nothing cost of performance state, if you had the same 40-60 split, the revenue would be apportioned only to the 60% state and none to the 40% state. Both methods, the assignment of revenue occurs on a transaction-by-transaction basis, so you didn't look at the revenue overall. And New York, for instance, likes the cost of performance method because, most of the hedge and private equity managers here in New York and perform the work to collect their management fees here.
I understand that there's a third method that many states are gravitating toward. It's called market-based sourcing?
Yeah, that's right, Bob. More and more states are moving toward this market-based sourcing. As of 2016, 24 states had adopted the market-based sourcing rules in a myriad of forms. There's no real consistency. Which is kind of
I see you have your map up there.
Yeah. So that's what I was trying to show. Like if you're able to see this, some of the states are under cost of performance, proportionate. Some of the states are cost of performance, all or nothing. Some of the states are market-based sourcing, and then there's those few states like Washington and Nevada who don't have income tax. So and what happens as well, Bob, is that often there's different methods applied to corporate tax versus personal income tax, like in New York. Because of all these different methods, you might end up with more than 100% of the taxable income being subject to state income tax, and that's an effect.
Okay. So, what specifically is market-based sourcing?
So, market-based sourcing is when sales are apportioned to where the customer resides. So in the case of a hedge or private equity fund's management fee, which is based on a percentage of net asset value or how much money you're investing in that fund, in that particular fund, that means the revenue is allocated to where the investors reside. Obviously, this can get very tricky when you have a trust of trusts that are located in one place and the beneficiaries are in another, and the problem compounds with like fund of funds, as some states also have these look-through provisions. You can just imagine trying to track down where the ultimate investor resides if your fund accepts partnerships and other pass-through type entities as investors. And you've also got to keep in mind that when you have all these multiple filings, there's going to be more costs involved in terms of accounting fees and probably, registering with these states.
So is all income subject to these apportionment rules, Greg? Because it sounds like a nightmare. If the partnership receives income from other partnerships that may have a different proportion of sales, payroll, or property than the main partnership.
You're right, Bob. What you're referring to is this non-business or non-unitary income. Amounts that are passed through. So this is income that's usually not proportioned, but allocated. In the investment partnership world, generally this income is apportioned at the underlying partnership level, and its source is passed on to the main partnership level, and that sourcing is retained. This type of income could be like from oil and gas properties, real estate partnerships, patents, And generally, any required withholding would be at that underlying partnership level. But if it wasn't, for what reason, responsibility may fall to that hedge or private equity fund, depending on what information was disclosed to the underlying partnership by that hedge or private equity fund regarding the domicile and partner residency of the hedge fund or the private equity fund.
So the California investor in a New York City-based fund has New York income taxes?
All tax questions, Bob. The answer is it depends. Most states source investment type income to the state of a partner's residence, regardless of where a fund in the trading is actually located. However, this only applies to income from securities and does not apply to income that might be sourced to a particular state because of what it is. So again, the real estate income, the oil and gas royalties, all hedge funds and private equity funds are engaged in the business of loans, so loan origination fees. These are all types of income that would return their sourcing to the original states when it's passed through to investors. And so when private equity managers are looking at do some of these sorts of investments or this type of business, they have to keep in mind that there's going to be additional costs both for compliance and for both themselves and for their investors.
Covers investor is going to be impacted and affected. But the managers, the management fee and the performance fee or carve-out are sourced differently usually, correct?
That's right. So fee hedge and private equity funds charge based on net assets under management is subject to the state sourcing rules for revenue under cost of performance or market-based sourcing that we've been discussing. So the profit reallocation, which is also known as the carry, the incentive, or the carve-out, often is specifically excluded under a trading for its own account exclusion many states offer. To advantage of this exclusion, generally most hedge and private equity funds have the profit reallocation be given to a separate limited liability entity than the one receiving the management fee to preserve this exclusion and keep the income free of any state sourcing taint by, like, for instance, if management fee and the carry was received by the same entity, New York-based fund, it might be a problem because this is why New York-based funds generally split it, is to keep the incentive free of that 4% unincorporated business tax. And the carry generally ends up being taxed wherever the managers of the fund reside. Nearly every state has a form of this exclusion, of this trading for its own account exclusion. How obviously, if the federal administration ever gets around to changing how the profit reallocation is currently taxed, and the states actually follow suit, this exclusion might disappear. But that's going to probably take a transition period.
So is it true that some states even require filing if no income is sourced there?
That's correct, and there's 8 states right now that require filing in a state if the partner resides there, even if no income is sourced there. So accepting investors from California, Georgia, Missouri, New York, New Jersey, Oregon, Pennsylvania, or Utah, you're going to have to, the hedge fund or the private equity fund is going to have to do filing there. And each state has its own nuances that complicate matters. Some don't conform to the federal bonus depreciation. Most don't allow a deduction of taxes based on profit. And many have a presentation much different than the federal forms. Pennsylvania, for instance, has given practitioners and partners headaches for years. For accepting investors in any of these states, the fund managers or the private equity managers should really consider the additional costs for compliance in the states.
So what happens if a partnership has state-sourced income? Because I understand that some states are extremely aggressive about required filing and withholding by the partnership, even if it's only $1.
Many states require an entity to withhold state income taxes on the income sourced to non-resident partners, whether those partners are foreign or domestic. These withholding requirements generally are done at a fixed rate and usually dependent on the partner structure, be it an individual, a corporation, or a foreign, either a foreign individual or a foreign corporation. Sometimes the withholding is due on income, as in New Jersey, and sometimes it's due on distributions, as in California. Obviously, with the withholding being due on distributions in California, as opposed to what's actually on the K-1, the state, in terms of the income, this can cause a headache, as the state apportionment percentage might change year to year, and the distribution could be of like prior year income.
Are there any ways to mitigate the impact of all these filings? And I can only imagine investors wouldn't want to give their money to a partnership if it required them needing to file an income tax return in all 50 states.
Yeah, some states offer partnerships the option to file a composite return that you may have heard of. In a composite return, the partnership pays the partner's state income tax liability on their behalf. And when they do that, sometimes the partners don't have to do the filing. However, when the withholding is done on the composite return, the tax rate is generally the highest marginal rate imposed by the state. And partners are not able to take advantage of any itemized deductions they might be if they were to file their own Form 40, or if they receive losses from another partnership that was sourced to that state. They can't offset the two. But if they end up filing, they're going to have to pay more accounting fees to prepare those additional returns.
So, Greg, what can happen if the partnership fails to remit required withholding to various states?
Well, it can expose the part to a liability for state taxes, and continued failure to do so could even lead to business licenses being revoked or being threatened to be revoked. It could also lead to a FAS 5 or ASC 450 issue, and possibly be an uncertain position for purposes of the audited financial statements. And the other impact is when you file a return, the statute of limitations doesn't start for that state, and so exposure wouldn't necessarily end after a certain number of years have passed, and so those are the impacts.
Other types of tax withholding that, when not done, expose a business to problems or liabilities. Not withholding payroll taxes is necessary, or remitting the amounts to both states for, like in the case of state-sponsored disability insurance, or the federally based Social Security Administration can have dire consequences as well. I mean, they generally go after Social Security if you do the withholding and don't remit it. They're extremely aggressive, and even more so than income taxes. So knowing the rules around these required withholdings is very important. And you also need to know when you have a employee versus an outside contractor. These sorts of things are all equally important. Great. Hedge funds and private equity managers have to be wary of sales and use tax. Well, correct.
That's right, Bob. Because despite not using to collect sales tax for their services, hedge and private equity managers may be subject to use tax on equipment they buy or services they did not pay a sales tax on. Let's say you buy a computer over the internet and have it shipped to your office in New York, but you didn't pay sales tax on that computer. You're probably going to be subject to New York use tax. Another thing to keep in mind is if you're purchasing research services or security services and you don't pay sales tax, you might be subject to that use tax. Or if you're like renovating your office.
True that artwork can fall under this purview as well?
Yes. States like New York have been extremely aggressive in recent times in arguing that expensive pieces of art displayed in offices that enhance the company's image of success and therefore are being used by the business and are subject to the use tax. Trying to claim the art was purchased for resale and that the manager is an art dealer has been contested in quite a few cases.
Well, I want to thank you for letting us know a lot more about this topic. Are there any takeaways that you'd like to emphasize, number one? And secondly, I see you have your contact information up on the screen. Terrific. So what are some of the takeaways?
First of all, I want to thank you very much for having me, Bob, and for providing this platform that we can tackle subjects and maybe educate some people in the industry a little bit more about taxes. Like I had said at the outset, states are becoming more and more aggressive in generating tax revenue, and many of them have identified market-based sourcing as a solution to their goals to create revenue. California is one state that made its mind to pursue taxes more aggressively and then hesitated, and now just recently doubled down and said we're going to do it. So they have to keep abreast of all the current developments. Stay current and navigating through all these different rules can be costly and possibly damaging if it's not handled right. I've obviously been dealing with these sort of issues most of my career, and would love to help anyone out that's concerned about that maybe they haven't taken a look at it, or with any other tax issues as well. We've still got a great team here at Baker Tilly that can fulfill everyone's accounting needs, and I've also written you other articles on our website that like the dealing with foreign investment companies and the blocker corporations. If anyone would like to look at that, those might be helpful as well. And I just want to thank you again, Bob.
Well, Kastner, Senior Tax Manager of Baker Tilly, again, I want to thank you for sharing your insights and your thoughts on this very important and complex issue. Again, I want to remind our audience that Greg's contact information is right in front of us. At this point, I'd like to see are there any questions from the audience? You can you know how to there. Do we have questions? It's a complex subject, so maybe the audience would like to think about this a little bit more and reach out to Greg at 646-776-6362. That's 646-776-6362. So if you have any questions, or Greg, do you have any final comments you'd like to make?
I guess, Bob, and yeah, please feel free to reach out. I'd be more than willing and happy to help out anyone with tax help.
So thanks so much, and until next month, folks.